Uh, Monetary policy. What is it? A lot of people talk about how it's central bank's responsibility to control inflation. And how do they do that? Well, basically by raising or lowering interest rates. Um, if there's a crisis, sometimes central banks also step in to buy bonds or sell bonds if they're unwinding their bond purchases. But this is just they only do this if they've already lowered interest rates at all the way to zero or close to zero. If they start buying long-term bonds, that will drive yields down and reduce borrowing costs. Now, the reason that you adjust interest rates and buy bonds is basically to make it more or less expensive to borrow money. So if it's cheaper to borrow money, if interest rates are low, that encourages households to go out and borrow more to buy a car or to buy a house. It encourages businesses to borrow if they want to expand and build a new factory or invest in some new technology. If interest rates go up, it discourages households and companies from borrowing. And that means that households and businesses will invest less and the economy will slow. So the more you borrow, that boosts economic growth. The less you borrow, it will slow down. Um, so adjusting interest rates is a way that central banks can encourage growth, encourage demand, or discourage it. And they do that by looking at how strong the economy is, whether they think it's overheating, whether inflation is too high. If they think it's overheating and inflation is too high, they'll raise rates. If they think the economy needs to grow more, they'll lower rates. So typically we talk about monetary policy as either neutral, which means that you're not neither encouraging nor discouraging borrowing, or loose, easy expansionary policy is when you're lowering interest rates and encouraging people to borrow, or restrictive or tight or contractionary. That's when you're raising interest rates. Both the ECB and the Fed target 2% inflation. The Fed also has a second mandate. The Fed has a dual mandate where they target not just stable 2% inflation, but also full employment. The ECB does not have this mandate, so they just look solely at inflation when they're deciding how to set their monetary policy. So this chart shows you what's been going on, what the Fed and the ECB have been doing recently. Um, Basically, you had this period before the pandemic where interest rates were super low. The Fed brought interest rates down to short-term interest rates down to 25 basis points. In Europe, the ECB actually implemented negative interest rates. That sounds a little crazy, but you can actually do that. You can bring interest rates slightly below zero as a way of really encouraging people and businesses to borrow. But once inflation spiked because of COVID and because of these wars, um, central banks responded by hiking interest rates very aggressively, raising them a lot very quickly. But then inflation started to correct itself and come down. And in fact, it came down much faster than people expected. And it did so without causing a recession. But central banks don't want to cause a recession if they can possibly avoid it. So both the Fed and the ECB have started cutting. They're removing their restrictive monetary policies by cutting rates. And this is should be good for growth in the long term, right? And this is particularly key for Europe because there's such large investment needs in Europe, um, particularly for the green energy independence transition, but also to improve their competitiveness in high-tech fields. Um, Businesses, people, governments all need to invest. And to do that, it really helps that interest rates are coming down. So that's monetary policy. And if you have questions, put them in the chat and I'll see if I can address them at the end. Next is fiscal policy. So fiscal policy is just government spending, right? But a good way to have a sense of what's going on is your government running a budget deficit or not? Um, if you are, if because just as central banks can promote or restrict demand by adjusting interest rates, Governments can also boost the economy by boosting spending or cutting taxes. Either one of those things can be expansionary. And so this tends to, in good times, typically what you're supposed to do is get your fiscal house in order, reduce your budget deficit if you were running one. But when times are bad, when you have a recession or when you have a pandemic, it's really important that the government be able to step in and spend money to, help the shock from getting any worse and preventing a deflationary spiral that will cause a recession to turn into a depression. So the budget balance is just the difference between how much taxes a government is bringing in how much revenue they're collecting through taxes, and how much they're spending. So if there's a positive budget balances, there's a surplus, and if it's negative, there's a deficit. Now, the issue is, in the long run, if governments keep deficit spending, and many governments run small deficits much of the time, this is usually okay. But if you start getting every time you run a deficit, you have to borrow money to fund that deficit. You have to go to the markets, the capital markets, and issue bonds, treasury bonds in the United States. In Europe, the German government issues its bonds and the French government issues their bonds. They borrow it, and then they have to pay that money back. Public debt is the total amount of money that the government owes, and it comes from the accumulated deficits over time. And typically we talk about that as a percentage of GDP. But if you let your debt grow too large, lenders might start to get worried about your ability to pay back all that money. And the way that they deal with that is by charging you a higher interest rate. They're like, this is a riskier loan that I'm making, so I'm going to charge a little bit more. Higher interest payments mean that a bigger proportion of your annual budget, of your annual spending, is going just to debt service, and you're not spending it on healthcare or investing in infrastructure or schools or whatever. And so a little bit of deficit spending can be okay and is the right thing to do if there's a recession. But when times are good, you tend to want to improve things and make sure that you don't accumulate too much debt overall. So this is really what happened. You can see here, this is an average of all the EU member states' general government budget balance since 2015. When the pandemic hit, deficits increased a lot, right? It increased to about 7% of GDP in 2020. This is a lot of public spending. They were spending it on to keep people employed, to give people unemployment benefits. There was a lot of healthcare spending. But now that this crisis has passed, governments have been consolidating, lowering their fiscal deficits. This is a typical countercyclical approach. It's good policy. Deficits are supposed to the aggregate rather budget deficit across the euro area is supposed to fall to 2.8%. That's the forecast by 2026. And this is going to, help prevent interest rates from rising on government debt too much in Europe. But I want to touch on a couple of debates that economists have. One is that some economists think that while it was important to increase spending during the pandemic, governments in both Europe and the United States spent a little bit too much. And if they just spent a little bit less, inflation wouldn't have gotten so bad. Instead of, peaking at 14% or whatever the peak was in the United States, it would have been a bit lower than that. You'd still would have had a spike, but the excess spending made it worse. This is one of the things that people talk about. But on the other hand, it definitely prevented a more severe recession. There's another thing in Europe, which is that Europe has fiscal rules because they have a single currency and a single monetary policy, but they don't have a single fiscal policy the way that the federal government in the United States is the is the largest component of public spending. Like states and local governments in the United States matter, but in Europe, the member states control a much larger share of total public spending. Because of this, Um, the architects of the euro area wanted to make sure that all the member states had to follow a set of rules, and this is what is called the Stability and Growth Pact. You've probably heard of this, that you're not supposed to run a deficit bigger than 3% of GDP in any given year, and you're not supposed to let your debt to GDP ratio rise above 60%. Now, Europe did go above that six, or many European countries did go above that 60% level. On aggregate, the aggregate level is 88% compared to 124 in the United States. Um, but some EU member states, some Euro area states, have debt to GDP levels above 100%. And so this is a cause of concern. Depending on what country you've chosen, you might be interested to know that 5 Euro area countries, Belgium, France, Italy, Malta, and Slovakia, have been put into what's called this excessive deficit procedure, which means that the European Commission saw that they were running budget deficits that were too large, that were above 3% of GDP. And now they have to take action agreed upon with the European Commission to bring that deficit down um, to below 3% in the coming years. Interestingly, another thing that I'm going to note, and this is an interesting difference between Europe and the United States, is that typically the politics, the political economy of budget consolidation works a little bit differently in Europe than in the United States. In the United States, when people talk about cutting the budget deficit, many people talk about, we need to cut spending. The government's spending too much. Let's figure out ways to cut spending. Um, in Europe, people like their public services. People tend to get very high quality healthcare and schooling and things like that from the government. And they don't want the government to cut public spending. And so instead, what countries tend to do is raise taxes. And that's what this chart shows you. The contribution to the change in the fiscal balance, right now there's consolidation. A big chunk of it, the yellow part, that's coming from revenues. That's coming from higher taxes, as opposed to expenditure cuts. There are some expenditure cuts, but they're not as big as the tax increases. So that just goes to show you that, you know, even when you're talking about improving your budget deficit, there's you don't have to do it. You have a number of different tools. You can raise taxes and cut spending or some combination. Okay, let's keep going. Um, Apart from monetary policy, apart from fiscal policy, there's another area of reforms that are super important. These are called structural reforms. These are a little bit harder to identify precisely what they are, but they're basically the institutional and regulatory framework that businesses and people operate in the economy and all the incentives that they face. So it's all the rules about labor markets. How easy or expensive is it to fire people? How generous or stingy are unemployment benefits? How many regulations and permits do you need to get if you want to start a business or add something onto your house? What happens if you need to declare bankruptcy? How are the courts going to deal with that? Is it an efficient process? It touches on a lot of different areas of governance, but increasingly people have realized that like this broader business environment, the broader economic environment really matters in terms of um, promoting economic growth, promoting the kinds of economic growth you want with higher productivity, higher technology firms, things like this. And so structural reforms are an important component of economic policy making, but they also tend to be politically very charged and very difficult to make reforms about because it often has to do with special interest groups. And special interest groups care a lot about their particular issue, whereas the general population maybe isn't aware, maybe doesn't know that much about it. And so special interest groups can lobby and prevent the kind of structural reforms that most economists think would really help the economy. So this brings me to the Recovery and Resilience Facility. I mentioned this before. This was a facility that the EU introduced during the pandemic to help cushion the shock, and now it's been repurposed to help also address the shock from the war in Ukraine. Basically, what it is a big pile of money, 672 billion euros, that the EU is making available to member states to make investments in green energy, infrastructure, things that will make the economy grow more and be more productive and improve the competitiveness of Europe over the long term. And so of this, roughly half, a little bit more, is in loans. 360 billion euros, 312 billion is in grants, which is, very means that the countries don't have to pay it back. This is a big amount of money, particularly for some smaller EU member states. And there's rules about it. There's rules about what you can spend money on. It has to be investments. At least 37% of the spending has to be on climate investment. 20% has to be on the digital transition. These are things that economists and policymakers have identified as necessary to improve productivity and deal with some of the challenges that Europe is facing. But anytime that you loan money or give money out, it comes with strings attached. And this brings me back to the structural reforms, because I mentioned before that fiscal policy remains mostly the responsibility of member states, but this money is coming from the EU. And because this money is coming from the EU, they're able to say, hey, we have identified these areas where you could make some structural reforms to your domestic economy. Only if you implement them will we give you this money that you can then use to invest. And so there's been this process where the member state comes and says, here's my plan. I'd like to invest this much money in electric vehicle charging stations, this much in improving insulation in public buildings, this much in building new rail lines or public transportation, whatever it might be. And these are the structural reforms that we have identified. Maybe they're going to make the labor market more flexible. Maybe they're going to make the bankruptcy process more efficient. They present this plan, the commission agrees or suggests some changes. The member state says, okay, once the plan is approved, the money starts being dispersed. Doesn't happen all at once. It happens in tranches. So we'll give you this much, and then we'll wait to see that you actually implemented this reform, that your parliament passed some law that changes whatever needs to be changed, and then we'll give you the next pot of money. So that's how it works. And I just want to make the point that right now, last year and this year is the peak of disbursements of recovery and resilience facility grants. And this chart shows you what a big chunk, what a big percentage of GDP it is for several countries like Spain and Italy and Greece and Latvia are getting like around 5% of GDP just in RRF grants. And that's a macroeconomically significant number. On average, most EU countries are going to see the RRF adding about 2% of GDP over the life of the program. But right now it's happening that's on average over 5 years. And a lot of the money's flowing right now. And so this is one of the reasons why the commission has forecast growth is going to pick up over the next couple of years. So maybe just to sum up a little bit, I know that I've covered a huge amount of ground here, and I hope it hasn't been overwhelming. If you want to ask some questions, please feel free. But basically, just to sum up, there have been these big economic challenges facing Europe in particular, more so than the United States. The European economy has shown a lot of resilience, but this resilience has been helped by effective policymaking on the part of the European Commission and member states. There have been a lot of steps taken to first counteract the effects of the pandemic, then deal with this energy price shock. That Europe had to find entirely new sources of natural gas and oil to replace the supplies that they used to get from Russia. They managed to do so with while keeping the lights on and preventing, you know, people from being cold in the winter. People were still able to heat their houses, and businesses were able to keep operating. Um, the ECB has done a lot to manage inflation and help bring it down in this immaculate disinflation, without causing big job losses. And this is sort of what the Euro Challenge is about, right? You're supposed to put yourself in the shoes of policymakers, think about what challenges they face, and come up with ideas to solve these problems. And so I'm not going to tell you that Europe has solved all of its problems, because it clearly has not, and there's always a new problem coming up down the road. But informed, proactive, effective policymaking can make a big difference. And I hope that some of the stuff that we've been covering today helps explain like what some of the things that policymakers are looking at and some of the tools that they can use to help growth. So let's talk a little bit about risks in the future, because I just mentioned that there's always new risks on the horizon. Um, the key one probably now is U.S. trade policy, but there's also upside risks. Not all risks are negative. The upside risk is that, you know, people have a lot of money to spend in Europe. They have jobs, they have real wage growth, they have high savings, interest rates are coming down. If sentiment improves, that's going to encourage people to spend money, which will in turn cause businesses to sell more goods and start hiring more people and have this virtuous cycle. Growth could actually surprise to the upside. Another positive risk is that not just the money from the RRF, but the structural reforms that countries have been engaged in help improve the underlying competitiveness of the economy and improve the business environment. So companies are like more willing and able to create new technologies, and people start new firms and all that kind of thing. So those are the upside risks. The downside risks are that ongoing conflicts in Ukraine and the Middle East could threaten energy supplies and keep sentiment from improving as much as they should. Um, there's also, I'm going to go out of order here. There's also some domestic political instability in Europe. There's big elections coming in Germany in the short term, and there's going to be a new German government, or it's widely expected that there's going to be a new German government. Germany is the single largest economy in the euro area and the EU, so having a German government that is able and willing to make big decisions is really important. But other countries also have elections coming up in Europe. And so it's important for that stuff to get squared away, because some of the uncertainty about what kind of policies these expected new governments might pursue might be keeping business investment lower than it might other be. Businesses might be waiting to see what's going to happen before they commit to big new investments. The biggest risk is that US protectionism upsets global trade and leads to fragmentation. Europe is a very open economy. Um, they trade lots of goods and services all around the world. If global trade is severely affected by trade wars and tariffs and things like this, that will weigh on growth in Europe. Um, and so we'll see. European trade negotiators will have their hands full dealing with the Trump administration, but you know, it's not just that the U.S. could impose tariffs. If the U.S. imposes tariffs on Europe, Europe is very likely to retaliate, and that could mean that it's harder for U.S. companies to export goods to Europe, which will also hurt U.S. growth. And there's also the risk that this could boost inflation around the world again. Um, so there's always risks, but I hope this has been useful to you. If you do have questions, I'm happy to try to answer them. But otherwise, I wish you good luck in all the research that you're doing, and I look forward to seeing you. I will be in New York for the finals for those of you who get there. But otherwise, best of luck.